The dangerous lie of safe investing. Most people don't invest to get rich. They invest to feel safe. Safe enough to sleep at night. Safe enough to believe their future is handled. Safe enough to stop worrying about money. And somewhere along the way, the idea of safe stocks became a promise, a quiet agreement between Wall Street and everyday people. Buy the right companies. Hold them long enough. Don't take risks. And everything will be fine. But here's the uncomfortable truth no one likes to say out loud. Most safe stocks aren't safe at all. They're just familiar. And familiarity feels like security. Imagine someone who worked the same job for 30 years. They never chased trends. Never gambled. They invested in well-known companies, household names their parents trusted, brands they saw on TV every night, companies that had been around longer than they had. That person did everything right. And yet, years later, their portfolio barely kept up with the cost of living. Some holdings collapsed slowly. Others didn't collapse at all. They just quietly stopped growing while the world moved on without them. No dramatic crash. No warning headlines. Just time doing its damage. This is how safe investing really fails people. Not loudly, but slowly. The idea of safe stocks is rooted in something deeply human. We crave certainty. We want rules that protect us from regret. So when someone says, "This company has been around forever," our brain translates that into, "It will always be here." But markets don't reward longevity. They reward relevance. There was a time when General Electric was considered one of the safest investments on earth. It was in retirement portfolios, pension funds, index funds, and family trusts. Financial advisors recommended it without hesitation. It paid dividends. It had history. It had prestige. GE wasn't just a stock, it was a symbol of stability. And yet, over time, it became a case study in slow erosion. Poor capital allocation. Changing industries. Management mistakes. Debt. Declining innovation. By the time most investors realized what was happening, the damage was already done. Not because GE disappeared overnight, but because safety blinded people to risk. That's the pattern you'll see again and again. Safe stocks don't usually explode. They fade. And fading is harder to notice than crashing. This is where psychology takes over. When people buy something labeled as safe, they stop paying attention. They stop questioning assumptions. They stop asking uncomfortable questions like, is this company still growing? Is it adapting? Does it still matter? Safety creates complacency. And complacency is one of the most expensive emotions in investing. Think about how many people were told to buy stable, retail stocks because people would always need stores. Or traditional media companies because they had loyal audiences. Or legacy telecom firms because they paid consistent dividends. Those stories sounded logical. They felt reasonable. They felt safe. But logic without adaptation is just tradition wearing a suit. The market doesn't punish investors for being wrong right away. It punishes them for staying wrong too long. One of the most dangerous assumptions investors make is believing that volatility equals risk, and stability equals safety. In reality, volatility is often visible risk. Stagnation is hidden risk. A stock that barely moves for years feels calm, predictable, reassuring. But if inflation is quietly eroding purchasing power, that safe investment is actually losing value in real terms. You don't feel the loss immediately. You notice it years later, when retirement looks smaller than expected. This is why so many people feel betrayed by investing, even when they followed all the rules. They didn't gamble. They diversified. They avoided hype. But they also avoided growth. And over time, avoiding growth becomes its own kind of risk. modern markets have changed in ways most traditional advice hasn't caught up with. Technology moves faster. Industries shift quicker. Entire business models become obsolete in a decade instead of a generation. What used to be a safe 40-year investment horizon is now filled with uncertainty. And yet people are still told to trust the same labels. Blue chip. Defensive. Stable. Low risk. Those words sound comforting, but they're not guarantees. They're narratives. And narratives are powerful. They shape how we invest, how we hold, and how long we stay loyal, even when evidence says we shouldn't. This is where the emotional cost begins. Because when a safe stock underperforms, people don't just lose money. They lose confidence. They start doubting themselves. They blame timing, bad luck, or the economy, never the assumption that safety itself might have been misunderstood. No one tells you that safety is not about avoiding movement. It's about surviving change. And companies that stop changing are often the riskiest of all. In the coming episodes, we'll explore how this illusion shows up in different forms: blue chip stocks that stopped innovating, dividend payers that trapped investors in mediocrity, index funds that concentrated risk instead of spreading it, and retirement systems built on outdated assumptions. Not to scare you, but to wake you up. Because the most dangerous risks in investing aren't the ones that make headlines. They're the ones that feel normal. They're the ones everyone agrees on. The ones passed down as wisdom. The ones no one questions anymore. And that's why this series matters. Because once you see the hidden risks behind safe stocks, you never look at stability the same way again. And in part 2, we'll take this illusion even further, into the world of blue chip stocks, and why too big to fail has failed investors more times than they want to admit. Blue chip stocks too big to fail. Until they do. There's a phrase that has quietly shaped millions of portfolios for decades. Too big to fail. It sounds like protection. Like scale equals safety. Like size itself is a shield against loss. Blue chip stocks sit at the center of this belief. They're the giants. The names everyone recognizes. The companies featured in textbooks, retirement plans, and financial commercials. They sponsor stadiums, appear in history books, and dominate entire industries. And because they've survived for so long, people assume they always will. But history tells a very different story. At one point, Kodak was a blue chip stock. So was Sears. So was Nokia. So was IBM, General Motors, and Lehman Brothers. Each of these companies wasn't just successful, they were dominant. They employed hundreds of thousands of people. They were woven into everyday life. They were trusted, respected, and widely owned. And yet dominance did not protect them. It delayed the realization of risk, and that delay made the losses worse. Blue chip stocks fail differently than speculative ones. They don't collapse suddenly. They decline quietly, slowly, and often with dignity. The brand remains recognizable long after the stock has stopped rewarding investors. That's why they're dangerous. Because people don't panic. They wait. They hold. They assume recovery is inevitable. Take Kodak. For decades, Kodak wasn't just a photography company, it was photography. It had market power, patents, and a brand people trusted with their memories. Financial advisors loved it. Pension funds held it. Families passed it down. And here's the part that surprises most people. Kodak actually invented the digital camera. But being big made it cautious. Protecting its existing business felt safer than disrupting it. Management feared change more than stagnation. And while Kodak protected yesterday's profits, the world moved forward. By the time investors realized Kodak's dominance was gone, the stock had already done the damage. Not overnight, but over years of slow decline that felt temporary at every step. That's how blue chip risk works. It disguises permanence as safety. Another example is General Motors. For generations, GM symbolized American industrial strength. It was the backbone of retirement plans and union pensions. It felt untouchable. Until it wasn't. When GM filed for bankruptcy during the financial crisis, many long-term investors were shocked. They didn't think bankruptcy applied to companies like that. The company survived, but shareholders were wiped out. This is an uncomfortable truth. A company can survive while investors don't. Blue chip status protects brands, not portfolios. And yet, even after examples like these, people still assume scale equals resilience. The reason is psychological. When we see a company everywhere, in stores, ads, news headlines, our brain associates presence with permanence. We mistake visibility for strength. Familiarity lowers perceived risk, even when fundamentals change. This is called authority bias. If something has always been important, we assume it always will be. But markets don't care about legacy. They care about adaptation. Look at how quickly technology reshapes industries now. Entire sectors can be disrupted in less than a decade. What once took generations now happens in a few product cycles. A blue-chip company that adapts slowly doesn't just fall behind, it becomes a drag on investor capital. Consider Nokia. At its peak, Nokia controlled more than a third of the global mobile phone market. It was innovative, profitable, and dominant. Investors trusted it implicitly. Then smartphones arrived. Nokia wasn't unaware. It just moved too slowly. Internal politics, fear of cannibalizing existing products, and overconfidence in past success created paralysis. The stock didn't crash immediately. It declined over years, trapping investors who believed recovery was just around the corner. This is the trap blue-chip investors fall into again and again. They confuse resilience with relevance. Being big doesn't mean being future-proof. In fact, size can make change harder. Large organizations have more layers, more legacy systems, more internal resistance. And while they protect what made them successful, smaller, faster competitors rewrite the rules. Another hidden risk of blue-chip stocks is capital misallocation. Mature companies often generate massive cash flows, but instead of reinvesting in innovation, they return it to shareholders through dividends and buybacks to maintain the illusion of stability. This keeps investors comfortable, but it can starve the company of future growth. From the outside, everything looks fine. Earnings are steady. Dividends arrive on schedule. The stock doesn't move much. But underneath, the business is slowly aging. This is how investors end up owning companies that look safe but are strategically exhausted. And because blue-chip stocks are often heavily weighted in indexes, their underperformance doesn't just affect individual investors, it affects entire portfolios built around passive strategies. People assume index exposure reduces risk. But when indexes become concentrated in aging giants, risk doesn't disappear, it becomes quieter. That's why some of the most painful losses happen to people who thought they were being conservative. They didn't chase trends. They didn't speculate. They trusted history. And history betrayed them, not because it was wrong, but because it was incomplete. The future doesn't reward what was important. This is especially dangerous for long-term investors. A blue-chip stock can underperform for 10 or 15 years and still feel safe because it hasn't collapsed. But over that time, the opportunity cost compounds. Money stuck in stagnation isn't resting, it's eroding. And by the time investors realize it, switching feels emotionally difficult. Selling a blue-chip stock feels like admitting you were wrong. Holding feels easier, even when it's costly. That's how loyalty turns into loss. None of this means blue-chip stocks are inherently bad. It means they are not what people think they are. They are businesses, subject to disruption, mismanagement, and irrelevance like any other. Calling them safe doesn't change that. It just makes people stop asking the questions that matter. In the next part, we'll explore another comforting illusion that keeps investors stuck: dividends. Why consistent payouts feel like income security, but often mask deeper problems beneath the surface. Because sometimes, the money that feels most reliable is quietly costing you the most. Dividends, the comfort that quietly destroys wealth. Dividends feel honest. You don't have to guess. You don't have to wait. You don't have to believe in the future. The money arrives anyway. That's why dividend-paying stocks are often described as safe. They're framed as responsible, conservative, mature. The kind of investment you graduate into once you're done taking risks. For many people, dividends don't just represent income, they represent reassurance. Proof that their investment is working. A steady reminder that they made the right choice. But this comfort comes at a cost most investors never calculate. Because dividends don't eliminate risk. They repackage it. Imagine someone approaching retirement. They're tired of volatility. Tired of headlines. Tired of watching markets swing. So they shift their portfolio into dividend-paying stocks, utilities, telecoms, legacy consumer brands. Every quarter, the cash arrives. It feels like success. But behind that comfort, something else is happening. The companies paying those dividends are often doing so because they've run out of better ideas. Dividends are not a reward for investors. They are a signal, and that signal is often misunderstood. A company that pays high dividends is usually saying, "We don't know how to reinvest this money for meaningful growth." That's not always bad. But when investors mistake that signal for safety, they step into a trap. Take traditional telecom companies. For years, they'd been favorites among dividend investors. Predictable cash flows. Essential services. Stable demand. The kind of stocks people hold forever. But look closer. Many of these companies operate in capital-intensive industries with slow growth, heavy regulation, and rising competition. Their revenues stagnate. Their margins compress. Their innovation lags. To keep investors loyal, they increase dividends. And investors applaud, unaware that those payouts are often funded by debt, asset sales, or declining reinvestment. The stock feels safe because it doesn't move much. But the business is slowly suffocating. This is the dividend illusion. Dividends give the impression of progress even when the underlying value isn't growing. It's like taking regular withdrawals from a savings account that earns less interest than inflation. The balance looks stable, until one day it doesn't. One of the most painful lessons in dividend investing comes from companies that maintain payouts long after they should have cut them. Why? Because management knows how emotionally attached investors are to dividends. Cutting a dividend feels like betrayal. Maintaining one feels like responsibility. So companies stretch. They borrow. They delay the inevitable. And when the cut finally comes, it's devastating. The stock drops sharply. Income investors panic. Years of perceived safety disappear in a single announcement. This has happened repeatedly across industries: energy companies during oil downturns, financial institutions during crises, retail giants during slow decline. Each time, investors are shocked. They shouldn't be. Because dividends don't protect you from business risk, they distract you from it. Another overlooked danger is opportunity cost. Dividend-focused investors often prioritize yield over growth. They choose a 5% payout over a company reinvesting aggressively for the future. In the short term, that feels smart. In the long term, it can be catastrophic. A company growing earnings at 15% annually doesn't need to pay a dividend. It compounds internally. A company growing at 2% often does, because it has nothing better to do with the cash. Over 10 or 20 years, That difference is enormous. Yet many investors lock themselves into dividend strategies during the most important compounding years of their lives, all in the name of safety. They sacrifice future potential for present comfort. And comfort is expensive. There's also a tax reality most people ignore. Dividends are taxed. Growth often isn't, at least not until you sell. This means dividend-heavy portfolios can quietly lose efficiency year after year, especially in taxable accounts. The investor feels productive because money is coming in. But after taxes and inflation, their real wealth barely moves. This is how people follow the rules, stay disciplined, and still fall behind. The most dangerous dividend trap, however, is emotional. Once people rely on dividends for income, or even identity, they become trapped. Selling feels impossible. Switching strategies feels reckless. So they hold. They defend the stock. They justify underperformance. They ignore warning signs. Because the dividend hasn't stopped, yet. This loyalty creates fragility. When markets shift, dividend-heavy portfolios often lag badly. They don't crash dramatically, they just fail to recover meaningfully. Over time, the gap between perceived safety and actual outcome widens. And that gap is where regret lives. None of this means dividends are useless. It means they are misunderstood. Dividends are not a guarantee of safety. They are a trade-off, income now for growth later. Stability today for uncertainty tomorrow. The problem arises when investors are told dividends are risk reduction, rather than risk relocation. You're not removing risk. You're moving it into stagnation, inflation exposure, and opportunity cost. And because those risks don't show up on a chart right away, they're easier to ignore. That's why dividend investing feels so good, right up until it doesn't. In a world changing faster than ever, clinging to payouts from companies that can't adapt is not conservative. It's fragile. And in the next part, we'll look at a strategy many believe solves all of this: index funds and ETFs. The ultimate symbol of modern safety. But what happens when safety in numbers becomes crowding, and crowding becomes risk? Index funds and ETFs, safety in numbers or a crowded trap? Index funds were supposed to fix everything. They were the antidote to bad stock picking. The escape from emotional decisions. The solution for people who didn't want to gamble, guess, or obsess. Just buy the market. Diversify automatically. Hold forever. Simple. Clean. Responsible. For millions of investors, index funds and ETFs became the ultimate definition of safe investing. No drama. No opinions. Just steady exposure to the economy itself. And for a long time, it worked. But safety, when everyone crowds into it, stops being safety. It becomes something else. It becomes fragile. Index investing is built on a powerful idea: diversification reduces risk. Spread your money across hundreds or thousands of companies, and no single failure can destroy you. That logic is sound, in theory. But in practice, modern index funds don't spread risk as evenly as people think. They concentrate it. Most major indexes are weighted by market capitalization. That means the biggest companies dominate performance. A small handful of stocks can drive the majority of returns, and the majority of risk. Investors believe they own the whole market. In reality, they're often heavily exposed to the same few giants. This creates a dangerous illusion. Because when those companies perform well, index investing looks brilliant. It feels effortless, intelligent, inevitable. But when conditions change, that concentration becomes a liability. What makes this risk especially hard to see is how passive it feels. No one is choosing these stocks. No one is making a judgment call. The index simply includes them. That makes investors feel protected from mistakes. But the market doesn't care whether risk is chosen actively or inherited passively. Risk is still risk. And when trillions of dollars flow automatically into the same companies, regardless of valuation, innovation, or future prospects, prices can detach from reality. This is how crowding happens. Index funds don't ask whether a company deserves more capital. They buy because they must. The bigger a company gets, the more it's bought. Success feeds itself. Until it doesn't. This feedback loop works beautifully in rising markets. It amplifies gains. It rewards momentum. It reinforces confidence. But in periods of stress, it can reverse just as quickly. Selling becomes mechanical. Withdrawals force selling. Rebalancing accelerates declines. And because so many investors hold the same exposures, losses feel synchronized. This is not diversification. It's shared vulnerability. Another hidden risk lies in how index funds shape corporate behavior. When a company knows it will receive capital simply by being large, incentives change. Long-term innovation can give way to short-term metrics. Buybacks replace breakthroughs. Financial engineering replaces bold strategy. The company stays in the index, and investors assume that means safety. But indexes don't remove weak businesses. They remove small ones. A declining giant can stay included for years while quietly underperforming, dragging returns and masking opportunity costs. And because index investing discourages scrutiny, few people notice. This creates a generation of investors who believe they're diversified, disciplined, and protected, while being exposed to the same systemic risks. It feels like safety because no decision is required. But not deciding is still a decision. The rise of ETFs has also changed market behavior in subtle ways. Liquidity appears abundant, until it isn't. Prices move smoothly, until they don't. In moments of panic, ETFs can trade at discounts. Correlations spike. Assets that were supposed to move independently suddenly fall together. This shocks investors who believed indexing removed complexity. It didn't. It hid it. There's also a psychological cost to index investing that rarely gets discussed. When investors are told they don't need to understand what they own, they stop learning. They stop questioning. They stop engaging. This works fine when markets reward passivity. But when reality intrudes, inflation spikes, growth slows, industries shift, confusion replaces confidence. People don't know what's happening to their money. They only know something feels wrong. And because index strategies are framed as set it and forget it, many investors stay exposed far longer than they should, not because it's optimal, but because it's familiar. This is how safety becomes inertia. Index funds are not inherently dangerous. They are powerful tools. But they are not magic. They don't eliminate risk. They redistribute it. And when too many people rely on the same strategy, that strategy itself becomes a source of instability. True safety requires understanding. It requires knowing why something works, not just trusting that it does. And that understanding becomes critical when the world changes. Because markets always do. In the next part, we'll examine a risk no index can diversify away, no dividend can compensate for, and no blue chip can escape. A force that quietly destroys purchasing power year after year, while investors congratulate themselves for being conservative. Inflation, the invisible risk no safe stock can escape. Inflation doesn't announce itself with panic. There's no breaking news alert. No sudden crash. No dramatic moment when everything falls apart. It works quietly. So quietly that most investors don't even realize it's happening, until years later, when the math stops working and the future feels smaller than expected. This is why inflation is the most dangerous risk for safe investors. Because it doesn't feel like risk at all. Imagine someone who spent decades doing exactly what they were told. They avoided speculation. They bought stable stocks. They focused on dividends. They chose familiar companies over exciting ones. Their portfolio didn't swing wildly. It didn't scare them. It felt controlled. But while they were watching the balance stay relatively calm, inflation was eroding something far more important: purchasing power. The number looked safe. The value was not. This is the illusion at the heart of conservative investing. People confuse nominal stability with real safety. A stock that returns 4% in a year feels successful, until inflation is 5%. On paper, you gained money. In reality, you lost ground. And because that loss doesn't show up as a negative number, it's easy to ignore. Inflation punishes patience without growth. It doesn't care how responsible you were. It doesn't care how long you held. It doesn't care how safe your choices felt. It only cares whether your capital grew faster than prices. This is why safe stocks are uniquely vulnerable to inflation. They are often mature businesses with limited pricing power. Their costs rise faster than their revenues. Their margins compress. Their growth stalls. They don't collapse, they underperform. And underperformance, compounded over time, is devastating. Look at utility companies. They are the definition of safe investing. Essential services. Regulated revenue. Predictable cash flows. But predictability comes with limits. Utilities can't raise prices freely. Regulation caps growth. Infrastructure costs rise. Debt increases. Over long periods, many utility stocks barely outpace inflation, if they do at all. Investors receive dividends, feel secure, and slowly fall behind. The danger isn't one bad year. It's 20 quiet ones. Inflation also exposes the weakness of relying on historical averages. Investors are often told that markets return a certain percentage over time. But those averages hide reality. Returns are uneven. Inflation is not. There are long stretches where, safe, stocks deliver mediocre results, while prices rise relentlessly. During those periods, real wealth erodes even if portfolios don't collapse. This is especially painful for retirees and near-retirees. When inflation rises, expenses increase immediately. But income from conservative portfolios lags. Dividends don't adjust fast enough. Capital appreciation doesn't exist. So people cut spending. They delay plans. They adjust downward. Not because they were reckless, but because they were too careful. Another overlooked aspect of inflation risk is how it distorts decision-making. When inflation is low, conservative strategies feel validated. Stability looks intelligent. Risk-taking feels unnecessary. But when inflation rises suddenly, as it often does, those same strategies become traps. Investors who prioritize safety find themselves exposed with no easy way out. Shifting into growth feels dangerous. Staying put feels hopeless. This is where regret takes root. The most painful part is that inflation rarely hits all at once. It creeps. It compounds. It disguises itself as inconvenience rather than crisis. Prices rise slowly. Quality declines subtly. Standards adjust quietly. And by the time investors notice, the gap between where they are and where they expect it to be feels impossible to close. This is why inflation is the ultimate test of an investment strategy. It doesn't reward caution alone. It rewards adaptability. Safe stocks often lack that adaptability. They are built for predictability, not acceleration. They perform best in stable environments, and struggle when conditions change. And conditions always change. Inflation is not an anomaly. It's a feature of modern economies. Ignoring it isn't conservative. It's risky. The tragedy is that many investors don't realize this until it's too late to course correct easily. They followed the rules. They trusted the labels. They believed safety meant protection. But safety without growth is just slow decline. In the next part, we'll explore another quiet danger that hides behind stability: stagnation. Because sometimes the greatest risk isn't losing money. It's owning something that never goes anywhere while the world races ahead. Stagnation risk: when stable companies stop moving forward. Stagnation doesn't feel like failure. There's no collapse. No panic. No moment where everything breaks. That's why it's so dangerous. A stagnant company still operates. It still earns revenue. It still pays employees and, often, dividends. It still appears on lists of reliable investments. But underneath that appearance, something crucial is missing: momentum. And in modern markets, momentum is survival. Many investors believe the biggest risk is losing money quickly. They fear volatility. They fear downturns. They fear making the wrong move. But over long time horizons, stagnation is often far more destructive than short-term loss. Because while you're standing still, the world is accelerating. Imagine investing in a company that performs well enough. Its earnings grow slightly. Its stock price moves sideways. Its business model remains unchanged. Year after year, nothing seems wrong. Until you zoom out. Competitors innovate. New technologies emerge. Consumer behavior shifts. Entire industries evolve. And the company you trusted doesn't fail, it just becomes less relevant. This is the slow death of safe stocks. They don't disappear. They get left behind. Retail is one of the clearest examples. For decades, large retail chains were considered stable investments. Physical stores. Established brands. Predictable foot traffic. Investors trusted them because they were everywhere. Then e-commerce changed everything. Some retailers adapted. Many didn't, at least not fast enough. Their revenues didn't collapse overnight. Their stores stayed open. Their stocks didn't crash dramatically. They stagnated. And stagnation over 10 or 15 years is brutal. Capital tied up in companies that barely grow doesn't just miss out on returns, it misses out on opportunity. Every year spent holding stagnation is a year not spent compounding elsewhere. This is why stagnation risk is invisible to most investors. It doesn't show up as loss. It shows up as missed potential. And missed potential doesn't trigger fear, it triggers rationalization. People say things like, "It's still a solid company. It's not exciting, but it's dependable. It's a long-term hold." These phrases sound responsible. They feel mature. But they often hide a refusal to confront reality. A business that isn't growing is slowly shrinking in relevance, especially in an inflationary, innovation-driven world. Another example lies in legacy media companies. For decades, they controlled information. Advertising flowed through them. Audiences were captive. Their dominance felt permanent. But digital platforms changed the rules. Attention fragmented. Revenue models shifted. Influence eroded. Some adapted aggressively. Others tried to protect old models. The result? Years of stagnation. The companies still exist. Their stocks still trade. Their brands still mean something, just not enough. Investors who trusted stability ended up holding assets that never recovered their former strength. This is the emotional trap of stagnation. Because nothing terrible happens all at once, investors stay loyal longer than they should. They remember how powerful the company once was. They assume a turnaround is coming. They believe time will fix what momentum has broken. But time doesn't fix stagnation. Change does. And stagnation is often the result of avoiding change in the name of safety. Large, established companies often fear disruption more than irrelevance. They protect existing revenue streams. They optimize what works, even as it stops working. This mindset looks prudent internally. It looks conservative. But externally it's fatal. Markets don't reward preservation. They reward progress. And when investors mistake preservation for safety, they inherit stagnation risk without realizing it. This is especially dangerous for long-term portfolios built around hold forever logic. Nothing deserves to be held forever, especially not businesses. Industries evolve. Consumer needs shift. Technology accelerates. Regulation changes. A company that doesn't evolve at the same pace becomes a liability. And yet, many investors don't sell stagnant stocks because selling feels like admitting failure. So they wait. They collect dividends. They accept underperformance. They hope. Hope is not a strategy. It's a delay. And delays in investing are costly. The most painful stagnation losses aren't measured in dollars lost, but in decades wasted. People reach later stages of life and realize their portfolio never truly grew. It survived, but it didn't advance. And survival is not the same as security. In the next part, we'll examine a force that accelerates stagnation into destruction: technological disruption. Because in a world driven by innovation, stability can turn into vulnerability faster than anyone expects. Technology shifts that destroy safe industries overnight. Every industry believes it's safe until it isn't. That belief is strongest in industries that have existed the longest. The ones that feel foundational, essential, untouchable. And that's exactly why technology hits them the hardest. Technological disruption doesn't ask for permission. It doesn't care about market share, legacy, or reputation. It doesn't move gradually. It moves decisively. And when it arrives, it turns stability into vulnerability almost overnight. For investors, this is one of the most painful realizations, because it shatters the idea that longevity equals protection. Think about how many industries once considered permanent have been reshaped or destroyed in a single generation. Photography, retail, music, media, transportation, banking. Each of these sectors was filled with safe companies, dominant players that seemed immune to competition. Until technology changed the rules. Blockbuster was once a cornerstone of consumer entertainment. It had stores everywhere. Predictable cash flow. Brand recognition unmatched in its space. From an investor's perspective, it looked stable. Netflix didn't. Streaming wasn't obvious. The internet was slow. DVDs still sold. Blockbuster had scale and experience. And yet, technology didn't need to be perfect. It just needed to be better. By the time Blockbuster realized the shift wasn't temporary, the damage was irreversible. What makes technological disruption so dangerous for safe stocks is how invisible it looks in the beginning. Early disruption rarely threatens profits. It threatens relevance. And relevance is harder to measure than earnings. This is why legacy companies often dismiss early warning signs. The core business still works. Customers still buy. Cash still flows. So management delays change. Investors, seeing stability, do the same. Then suddenly, the tipping point arrives. Customer behavior shifts faster than expected. New competitors scale quicker than imagined. Margins compress. Growth disappears. And the stock, once considered safe, enters a long decline. Not because it failed suddenly, but because it adapted too slowly. Transportation offers another example. For decades, traditional taxi companies were protected by regulation, scarcity, and infrastructure. Investors viewed them as reliable, local monopolies. Then ride-sharing platforms appeared. The technology wasn't revolutionary, but the model was. Asset-light. Scalable. Data-driven. Traditional taxi companies still operated. They still had licenses. They still existed. But their value collapsed. Investors who believed regulation guaranteed safety learned a hard lesson. Technology doesn't eliminate businesses, it reroutes demand. And once demand moves, it rarely comes back. This pattern repeats everywhere. Banks felt safe because of regulation and trust. Fintech changed expectations. Hotels felt safe because of real estate and scale. Platforms changed travel behavior. Media felt safe because of distribution control. The internet removed gatekeepers. In each case, investors trusted history. History didn't protect them. The most unsettling part is that disruption rarely feels dramatic while it's happening. The early stages look like noise. Small competitors. Niche users. Limited adoption. Investors dismiss them because they don't threaten revenue, yet. But markets price the future, not the present. And when the future becomes clear, it's already too late. This is why safe industries are often the most exposed to disruption. They're optimized for the past. They protect existing cash flows instead of building new ones. They avoid cannibalizing their own products. They delay bold moves to preserve stability. But technology rewards boldness. It rewards speed. It rewards adaptability. It rewards discomfort. And companies that resist discomfort in the name of safety become fragile. This creates a painful paradox for investors. The companies that feel safest are often the least prepared for change. And the companies that feel risky are often the ones building the future. That doesn't mean chasing every trend is wise. It means assuming permanence is dangerous. The lesson here isn't that technology destroys everything. It's that technology reshapes value faster than investors expect. And safe stocks are rarely positioned for rapid transformation. They are built to maintain, not reinvent. Which is why disruption feels sudden when it finally becomes obvious. And by then, portfolios built on stability are already exposed. In the next part, we'll look at how these risks compound inside systems designed to protect people the most, pensions and retirement funds. Because when safety fails at the institutional level, the consequences aren't just financial. Pensions, retirement funds, and the cost of playing it safe. For most people, retirement is the finish line. It's the reward for decades of work. The promise that if you show up, follow the rules, and stay disciplined, the future will take care of itself. And pensions and retirement funds are built on that promise. They are marketed as conservative, responsible, and safe. Designed to protect people who can no longer afford mistakes. But this is where the consequences of safe investing become the most personal. Because when retirement strategies fail, there is no time to recover. Imagine someone who spent 30 or 40 years contributing faithfully to a pension or retirement account. They didn't speculate. They trusted professionals. They believed the system was designed to protect them. Their money was invested in blue-chip stocks, government bonds, dividend payers, and broad indexes, all the traditional symbols of safety. And yet, when retirement arrives, the numbers don't add up. The income isn't enough. The withdrawals feel heavy. The future feels smaller than promised. This isn't because they were irresponsible. It's because the assumptions behind safe investing changed, and the system didn't. Pension funds, by design, prioritize stability over growth. They aim to avoid volatility, preserve capital, and meet predictable obligations. But in a world of low interest rates, rising inflation, and rapid technological change, stability is no longer enough. Safe assets don't generate the returns they once did. So pension systems stretch. They increase exposure to equities while still labeling them conservative. They rely on historical return assumptions that no longer reflect reality. They postpone hard decisions. And when markets underperform or inflation spikes, the pressure becomes visible. This is how underfunded pensions happen. Not because of one bad year, but because decades of safe returns quietly failed to keep up. For individuals, the impact is emotional. People feel betrayed. They did everything right. They trusted institutions. They believed safety meant certainty. Instead, they face reduced benefits, delayed retirement, or difficult lifestyle adjustments. This is the human cost of misjudged risk. Retirement funds often hold the same assets as everyone else: blue chips, index funds, bonds. When these underperform simultaneously, diversification offers less protection than expected. Losses aren't dramatic, they're cumulative. And because retirees draw income from these funds, they lock in underperformance. This is the cruel irony of conservative investing late in life. You are most exposed when you have the least flexibility. Another hidden risk lies in the emotional framing of retirement investing. People are told not to worry, not to look too closely, to trust the process. This discourages engagement. By the time problems become visible, the options are limited. The idea of safety becomes a constraint. People are afraid to change strategy, afraid to question assumptions, afraid to disrupt what little stability remains. So they accept less. They adjust expectations downward. And the promise of retirement security quietly erodes. None of this means pensions or retirement funds are inherently flawed. It means they are built on outdated definitions of safety. They assume slow change, predictable markets, and steady growth. The modern world offers none of those consistently. And the people who suffer aren't reckless investors, they're disciplined ones. This is the final form of safe stock risk. Not sudden loss. Not dramatic failure. But quiet disappointment. In the next part, we'll confront one of the most powerful forces behind all of this: our reliance on the past. Because what feels safe is often just what feels familiar. And the future doesn't care. Why the past feels safe, and the future doesn't care. Humans love stories. Especially stories about success, stability, and predictability. We study history to find patterns. We analyze past performance to make decisions. We assume that what worked before will work again. And in investing, this assumption is everywhere. People look at decades of market history and see growth. They see blue-chip dividends, reliable returns, and rising indexes. They extrapolate that the future will look the same. It feels safe. It feels intelligent. It feels like wisdom. But the future doesn't care about the past. It doesn't owe you consistency. It doesn't recognize loyalty. It doesn't respect tradition. Investors who rely solely on historical performance are exposed to the invisible risk of assumption failure. Let's consider the example of retail. Department stores dominated the 20th century. Investors trusted their brands. They paid consistent dividends. They had predictable sales. History suggested these companies were invincible. Then e-commerce arrived. Consumers shifted online. Distribution, convenience, and pricing changed the game. The past offered no warning. The rules of the industry had changed. Investors who anchored to history, who trusted that longevity meant safety, were unprepared. This pattern repeats across industries. Automotive, media, telecom, energy, every sector has examples where history misled investors. Sometimes the companies fail outright. Sometimes they stagnate. Sometimes they survive but never thrive again. And yet people keep repeating the mistake. Psychologists call this recency bias. People overweight recent performance when making predictions. They assume stability will continue. They underestimate change. Another factor is comfort. The familiar feels safe. People buy what they know. They hold stocks they recognize. They follow advice based on legacy reputation. Even when evidence suggests caution, familiarity overrides reason. This is why so many investors hold underperforming blue-chip stocks for decades. They trust history. They resist change. They hope. Hope is seductive because it's emotionally less painful than admitting that the past is irrelevant. The financial consequences, however, are real. Time compounds opportunity cost. Every year spent anchored to the past is a year not invested in the present or future. Meanwhile, companies that adapt to change capture growth, while stagnant or disrupted businesses lag behind. And this gap widens over time. Consider Kodak again. It dominated photography for decades. It had patents, market share, and consumer trust. Investors assumed its success was permanent. Then digital cameras and smartphones reshaped the industry. Kodak's historical dominance didn't prevent decline. It slowed adaptation. It created complacency. Investors anchored in the past suffered quietly, holding an asset that felt safe but was no longer relevant. This is why understanding change is more important than studying history alone. Markets are not linear. Success is not guaranteed. Safety is never permanent. Reliance on the past creates a false sense of security that masks real risk. Even sophisticated investors fall prey. Pension funds, index funds, and retirement portfolios often rely on historical averages to project growth. They allocate capital based on decades-old data. They assume stability will persist. And when structural shifts occur, inflation spikes, technology disrupts, consumer behavior changes, these assumptions fail. The consequences are compounded by time. The longer investors trust the past, the more painful the eventual correction. And this is the essence of risk in safe investing. It's not always about losing money. Often, it's about missing the future entirely. The companies that look familiar feel comfortable. They feel rational. They feel safe. But comfort is an illusion when the underlying dynamics have changed. This is why vigilance matters. Why questioning assumptions matters. Why understanding the why behind each investment is more critical than trusting what worked before. Because the past is a story. The future is reality. And reality doesn't care how much you trusted yesterday. In the next and final part, we'll conclude the series by showing how to redefine safety, not through illusion or comfort, but through understanding, adaptability, and awareness. Redefining safety, what most investors learn too late. Safety. It's the word every investor wants to hear. It's the promise whispered in brochures, repeated by advisors, and tattooed in conventional wisdom. Invest safely. Protect your future. Buy blue chips. Hold dividends. Trust the market. But by now, after everything we've explored in this series, one truth should be clear. Safety is a story, not a guarantee. Most investors learn this the hard way, after decades of disciplined investing, after watching slow erosion eat away at wealth, after trusting familiar companies that quietly became irrelevant. So, what does safety really mean? It's not a dividend. It's not a brand. It's not a history. It's not a label on a stock. Safety is understanding. It is knowledge of what you own, why you own it, and how it will respond when the world changes. True safety comes from clarity, not comfort. Let's break down what that means in practice. 1. Risk is invisible until it's not. Most people equate stability with safety. A stock that doesn't fluctuate much feels safe. A dividend check feels reliable. A blue chip name feels untouchable. But as we've seen, volatility is often visible risk, while stagnation, inflation, and disruption are invisible. True safety is recognizing hidden risk before it materializes. It's asking uncomfortable questions. Is this company innovating? Can it survive a decade of technological change? Will dividends still be sustainable in 10 years? How does inflation affect real returns? The moment you stop asking these questions, perceived safety becomes fragility. 2. Diversification is not a shield, it's a tool. Index funds, ETFs, and broad portfolios feel safe because you're not putting all your eggs in one basket. But remember, when everyone holds the same basket, the basket itself can break. Concentration risk, market feedback loops, and systemic factors mean that passive diversification alone is not protection. Safety is knowing how diversification works, what it hides, and what it does not prevent. 3. Growth matters as much as stability. One of the most common investor mistakes is prioritizing stability over growth. Blue-chip stocks, utility dividends, and predictable businesses feel secure, until inflation and opportunity cost erode their real value. Safety is not sitting still. It's maintaining a balance, protecting capital while participating in meaningful growth. That's why some risk is essential. The risk of being stagnant is far more insidious than the risk of short-term fluctuation. 4. Adaptability beats longevity. The companies we've studied, Kodak, Blockbuster, Nokia, all seemed safe because they were established. They were familiar. They were too big to fail. But none adapted fast enough to survive technological and social shifts. Safety comes from flexibility, from anticipating change, from preparing for multiple futures, not assuming yesterday guarantees tomorrow. For investors, this means not falling in love with legacy companies simply because they've existed for decades. 5. Emotional discipline is safety. All the analysis in the world won't help if emotions take over. Loyalty, hope, fear of admitting mistakes. These are all forces that trap investors in underperforming assets. True safety is being able to question assumptions, cut losses, and reallocate when evidence demands it. This is the discipline most safe investors lack. And it's the costliest oversight of all. 6. Inflation and opportunity cost are silent threats. Even a perfect portfolio can fail if it doesn't outpace inflation and opportunity cost. The safe investor who earns 3% while inflation runs at 5% loses value quietly over decades. They didn't take reckless risks. They were disciplined. But they were misled by comfort. Safety is not nominal stability. Safety is real, lasting value. 7. History is a teacher, not a blueprint. Past performance is not a promise. The world changes faster than the human brain can comfortably accept. Technology, regulation, demographics, and social trends can upend assumptions in a decade or less. Safety comes from understanding these dynamics, not from memorizing historical returns. 8. Redefining safety for the modern investor. So how do we actually redefine safety? Knowledge over comfort. Understand the companies, industries, and markets you invest in. Adaptation over loyalty. Accept that even long-standing investments may require reevaluation. Growth with protection. Include assets that compound wealth while mitigating risk. Awareness of hidden risks. Inflation, stagnation, technological shifts, all quietly destroy assumed security. Emotional control. Avoid decisions driven by attachment, habit, or fear of admitting mistakes. Safety is active, not passive. It's not achieved by buying familiar names or holding forever. It's built by engaging with change and preparing for uncertainty. 9. Real-life lessons. Consider someone who followed conventional advice for 40 years, bought blue-chip dividend stocks, avoided volatility, relied on index funds. They never lost money dramatically. They never panicked. They felt safe. But at retirement, they realized their real purchasing power has eroded. Their portfolio didn't grow enough. Their lifestyle needs adjusting. Contrast that with an investor who embraced growth alongside stability, monitored trends, and adapted allocations over time. They experienced more volatility but maintained real wealth and flexibility. The lesson is clear: perceived safety without action is a trap. 10. The final takeaway. Most safe stocks are risky because they promise what they cannot guarantee. They rely on familiarity. They rely on historical success. They rely on dividends, size, or indexes. These things feel comforting, but comfort is not security. True safety comes from understanding, adaptation, and strategic awareness. It comes from embracing uncertainty rather than pretending it doesn't exist. It comes from asking the hard questions, even when it's uncomfortable. What if this company no longer matters? What if growth stalls? What if inflation erodes returns? What if the next technological shift makes my safe investment obsolete? The earlier you start answering these questions, the safer your wealth becomes. Because in the end, safety is not about avoiding risk, it's about managing it wisely. And that is the lesson most investors learn too late.